Larry, Scott, welcome.
Thank you for having us.
Man, this has been a few weeks only in the making. This kind of happened pretty quick. I was excited when I saw this on the schedule this week. We got, it's straight up Chicago. We're going to be sponsoring an event with you guys coming up here. What's it, June 13th?
June 13th from 6 to 9 at 𝗬𝘃𝗃𝗃 Brewery and Kitchen in Oak Brook.
All right.
Don't miss it.
There it is. Look at that.
That's right.
Coming out hot. I like that.
Yeah, that's right.
Well, here, you guys both got backstories. I'm curious, just kind of hear briefly how you guys started. We were joking with you earlier before because your LinkedIn's a little blank, and we thought maybe
Yeah, it just got out of the can, man.
Yeah, that's what I went with. Yeah, tell us kind of your background in lending and
Sure.
maybe how you guys came together.
Want me to start?
Go ahead.
Well, I graduated from college in 2002, so hopefully that doesn't date me too much. But I just didn't want to live in Wisconsin anymore, so I went to a job fair. I walked up to a table at 𝗦𝘃𝗶𝗵𝗵𝗁 Mortgage, and I got hired. I just needed a job. Didn't really know what a mortgage was or anything.
So you're here because of a job fair, huh?
Yeah,
That's very old school.
Yes.
Now that is dating.
Yeah, that's right. A job fair, man.
I haven't heard that name in a while too. 𝗦𝘃𝗶𝗵𝗁. That was like 120% LTV.
Yeah,
Like, I
that's
remember those
right.
guys.
We did them all, man.
I remember that.
You don't need a LinkedIn to get a job, right? Don't recommend that anymore. But anyway, I worked there, and then after a while, you're just like, okay, this is not exactly the type of lender that I want to work with, or for. They just did a lot of unique things, and I was just so that's when I went and explored other opportunities, and then I ended up at H&R Block Mortgage, same company as the tax preparers. They were the retail arm of Option One, and that's where I met Scott. I think you interviewed me on a sawhorse. It was
That's right.
The center was getting built out. It was a really nice center out in Rosemont.
And here
over
we are on
River
the
Road.
podcast.
Yeah, that's right.
Ta-da.
And that was the rest was history pretty much. And so I pretty much stayed there until 2008, when things got a little rougher. And then I ran a net branch, where I lent direct to consumer, where I thought, I could do it better. But owning your own business isn't always the glamour you think it is. There's a lot of expenses to it, marketing, and you're also the IT person, you're the complaints department, you're whatever, man. You're the audit trail. It just was a lot of hats. So I was sitting at a gas station because somebody texted me and said, "Hey, your voicemail is full." So then I went through it a little bit and just kind of listened to him. Delete. And then I heard his voice. Returned his phone call and he was like, "Hey, I think I can give you a good 5-year run at least." And here we are, 6 years later, and going strong. And I really enjoy the space. I always enjoyed mortgage lending. I particularly like the commercial space. I like dealing with the investor a little bit better. I think it's more for my skill set. So,
Yep. Good stuff.
Yeah.
Scott, how about you?
Short shout out there for the grassroots recruiting efforts. Paid off on my part.
Yeah.
I'll save you some of the backstory for the sake of time here. Mine goes a little bit farther back than Larry. I'll take you back to the early 2000s. I was AVP district manager here in Chicago, running the Chicago region. Held a similar position with 𝗬𝘃𝗶𝗵𝗵𝗁 Bank. Found my way into the business purpose space with Jordan Capital Finance up in out of Northbrook, Illinois. They were purchased by Finance of America. So this is actually my second transition through ownership with the same organization. But I've been in the business purpose space since 2016. Like Larry, I love it. This is really where you start to really build lasting relationships, with your clients and your teammates.
Most of our listeners are pre-Great Recession. Give us any kind of crazy
Post.
I'm sorry. Yeah, they're post. You mentioned you like what they're doing there at the previous firm. Like, give any crazy stories that people would appreciate these days of like how nuts things were in the early 2000s.
Well, there's a lot of them.
Inappropriate, whatever it might be.
A lot of them. Just the way we were doing back at that time. Option One, we were doing the 228s. Fixed for 2 years with unbelievably big margins, and the rest is history as far as how that went through. But it's definitely changed a lot since those days.
yeah, if you were talking office culture, I mean, if you ever watched The Wolf of Wall Street, and like some of the office antics was always pretty fun to be in there. Remember that one guy in Switzerland when he jumped in the pool cover
Oh,
you know?
Yeah, ran across the $20,000 pool cover.
Yeah. The hotel just slipped them the bill. You know what I mean?
We've come a long way since Beer Cart Tuesday.
Yeah.
So
Yeah.
I
so-
love that. So the pre recession mortgage world was like Wolf of Wall Street.
well, I mean, it had its fun, you know.
Definitely closer.
Yes.
Oh man, how the world's changed.
Well, I just remember the lending going back to some of these names. Like you'd go to refi someone and they'd have a second mortgage at 120% loan to value. And it's like, yeah, well, it's just going to go up next year and it'll get back to 100. It's like, obviously, it sounds so silly to say now, but it was like the norm. Like that was something that was just happening.
Yeah, if I didn't leave with $10,000-$15,000 from a closing, I screwed up the paperwork somehow, or I didn't
Yeah.
maximize the opportunity. Like that,
Yeah.
that was kind of the craziness. And then if Aquin didn't buy that note 6 months later,
yeah.
6 weeks later, like
Yeah,
something was weird
OCW,
too.
forgot about them.
Or
Yeah.
Greenpoint was the other one going.
Yeah.
Yeah. Greenpoint was big. No, that was, you know, all those kind of, you know, looking back, those products, you know, they were destined to fail, right? They don't make sense even when you say it out loud. You know, even when you're explaining them to people, you're just like, yeah, I don't know why anybody would have ever, you know, thought that was a great idea, right? And I think now, at least today in this space, you know, I think they're, you know, they really watch for default, and I think they really mitigate risk by, you know, they don't really lend to uncreditworthy people, in my opinion. Now we'll take chances on newbies and stuff like that, but you know, the bottom line is you still have to kind of, it has to make sense, right? And that's what I like about this business. If it, you know, and that's how it's easy for me to advise people because, you know, ask them, you know, straight out, hey, why do you want this deal? You know, because sometimes they'll be, you know, crazy numbers, and I'm just like, that doesn't make a lot of sense unless they have a different plan. Sometimes they'll tell you, oh, it comes with an adjacent lot, or, you know, hey, I plan on knocking it down or building a brand new house, or, you know, stuff like that. So I think things today got to make sense.
Yeah, well, it's nice just in general in this space. On the long term, you have to hit DSCR, right? You have like these, even if you don't know what you're doing, you have these guidelines in place.
That's
like
right.
you have to hit DSCR, which is setting at least a good benchmark of, okay, are you going to default or not? And same on the fix and flip, right?
That's
you guys
right.
are getting an ARV on this thing.
That's right.
And if that thing comes in lower than what they're expecting, all of a sudden, hey guys, like this isn't working, right? Like it's
That's right.
almost like I know people say, oh, it's risky to take on these short-term loans, but there's almost like a built-in like security when you do it because they have the guidelines. They don't want you to fail.
Oh, that's right. And I think, you know, from underwriting, from when the loan gets boarded, you know, we all try to mitigate that risk together, right? And ultimately, you're trying to save that investor too, because again, there's been projects where I said, hey, I don't think this makes sense, and they went ahead and did it, and they came out just fine, right? There's also been the flip side of that too, where, you know, 18 months, and you know, somebody's in special servicing, you know, and you're just like, oh, I remember this one. I warned them, right? I said, I don't see it. But at the end of the day, I think all lenders kind of mitigate their risk, you know, by either requiring more skin in the game, you know, with a larger down payment. Like you said, it's got to cash flow. It's got to make sense.
Well, you guys say credit score, and I think that's been pretty constant the last 10 years. Like you have to hit a certain threshold. I think the standard deviation of risk when it comes to, call it 600 to 680 versus 680 to 760, it's got to be huge in your guys' world.
Yeah, we don't even really call it hard money anymore, right? Because of the way we lend, it's really based on that credit. Our average credit score is, you know, 720 plus, and experience. And really one of the way, I think the primary way we mitigate risk is really when we evaluate their experience and the proposed project at hand, we're really looking at their past experiences and really how it aligns with what they're proposing to do, and just to make sure it's a good fit. Obviously, as they get more experience, you're able to kind of open that door even wider. But it's just a great look back on what they've done and what they're capable of doing.
Well, before we go any further, you guys just went through. Tell us about you're with a company. You guys got bought out. Tell us about that trend. Just tell us about the company, what flags you're flying under, and what parent company, so forth.
Sure. So you know the transition happened March of 2023. You know, honestly, you know, you're probably looking at two guys here were the last to know about what was going on at the time. I look back and it was a blessing. You know, during a very difficult time, that me and my team were able to stay extremely focused on just delivering for our clients. We never closed down. We delivered all the way through the transition, which was extremely challenging. And we ended up being very, very fortunate. Rock360 is our parent company now. They're really a vertically integrated platform. with the full ecosystem, title company, appraisal management company, insurance companies. They're approaching now $30 billion in closed loans in the investor space. So it's been refreshing to have a parent that is focused on the business purpose versus residential.
You guys flew and still fly under Finance America, which that's not a small company either. Like that, the whole company in itself is just part of it, correct?
Well, we were just the commercial division was sold.
Okay.
The residential side, the consumer loan side, was closed, and all that remains with the old company is just reverse mortgages.
Got it. So the fix and flip and the portfolio loans are now part of Rock 360. Just to
Correct.
put
That's
that out there
correct.
clear.
Correct.
Okay.
Yeah.
And let's take one step back for someone looking to get started. Just give us that one-on-one. Like, where could you be of help to them? Like, they're buying something turnkey. That's probably not the right move. But just give us that 30-second elevator pitch or 2-minute elevator pitch of where you would fit into someone's toolbox.
Well, I think we're basically should be the first stop, right? Given our experience with knowing a deal, I know market trends from really coast to coast. I understand the investor mindset, their strategies, and I've seen various strategies. Remember Patrick Stanford?
Oh, yeah.
It was a $10 million portfolio loan that I closed. This was back, a few years ago, right before COVID hit. But he had a strategy right around outside of university. He bought probably 50 properties, got them kind of cleaned up, stabilized. A lot of them were, rented out to students and stuff, I'm assuming. But, 3 years later, he comes and pays it off, and he made $5 million on that, right? Where can you go, and start from nothing and make $5 million unless you're like, playing on the Bulls or something. You know what I mean? It just, it's stories like that becomes real. So, for somebody just starting off, right, brand new, hey, I just watched HGTV, I want to flip a house, right? If you don't have a support system like Chicago REIA or, like one of those groups, you can always, revert back to somebody like myself, a loan officer that knows the market and can kind of coach you a little bit on the pitfalls, because the last thing you want to do is see that person fail because you'll never see him again, right? So by helping them and just kind of telling them, hey, I'd pay attention to this, hey, this, here's a couple other market trends, just that little tiny advice might be enough to just get them over the finish line. So
well, shout out to Gary Davidson, because Gary Davidson's who connected us. And
Yeah.
I don't know what episode he was, but
I don't have my notes in front of me.
episode
It's I know a
somewhere
guy.
0
That's
to
what it's
100.
called.
Yeah,
Connector.
I got
Yeah.
I got a guy.
I got a guy.
So shout out to Gary,
Yes.
which is huge. You guys also, you said mastery program. You guys worked with Andrew Holmes and his group
Yeah.
as well too.
I've had the pleasure of being able to, help out with a lot of their loans through various investors through that group. They've been a tremendous resource. I think, anybody also starting off, I think that type of group is so important for a new investor because of the networking aspect. They have contractors, electricians, plumbers, title agents, insurance people. Basically you have a variety of different. So even if you don't mesh well with one person, that's all right. You can go to the next company or the next guy or whatever. And where can you go get those resources to have other like-minded people being able to kind of review your deal, see your addresses, see your project numbers, and really understand what you're trying to do? Not a whole lot of places, right? So those kind of groups, in my opinion, are extremely valuable to avoid the pitfalls, because guess what? You make one mistake, you buy a house and you're probably never doing it again, right? Maybe one real ambitious people will learn from their mistakes, but most people, can't afford to do that, right? So what can you afford to do? I can afford to make the right decisions up front. And that's picking the right lender, picking the right everything, real estate agents. An agent's not an agent, right? So it's surrounding yourself with the right attorneys. If you got the right network, man, you'll succeed.
Yeah, no, absolutely. I know Andrew Holmes was episode 50 the first time we had him on.
Yes,
That's the
yes.
one I know. So 50, and we had him on again. And Lance will link to all this in the show notes.
Yeah, I anytime you can just bypass, like, here, read this book, good luck. You know what I mean? You need boots on the ground. You need somebody to kind of hold your hand and show you exactly step by step what you're going to do. you
Yeah.
know?
And just to be clear too, you guys will also do, well, I call them stabilization loans, but after the project's finished and you're looking to rent out, whether it's a single family home, a 4-unit, whatever it may be, you guys will do the DSCR loan on the back end. Can you talk a little bit about that program?
Sure. The DSCR program really is designed for the long-term hold. We'll do a purchase, cash out, refi, rate, and term. Some of the strengths of that program, we really go up to 80% purchase, rate, term, up to 75 cash out. One of the things that our program is very strong with is 90-day seasoning. So after 90 days, we'll take the fair market value of the property. So a lot of our strategy, a lot of our clients will invest the strategy of buying the properties distressed, rehabbing them, getting them stabilized and rented, and then look to refinance them, cash it out, pull their initial investment back. So now they have a cash flowing property without tying up all their money, and then they just rinse and repeat. So that product, so we have the single product, and then we also have portfolio, which could be really an unlimited number of doors all wrapped into one loan.
Got it. And is that, when you say unlimited amount of doors, that can be almost cross-collateralized against different assets, correct?
That's correct. On the blanket loan, they are all cross-collateralized. So you have the single asset or you have the portfolio. And the portfolio would be all cross-collateralized. Typically, we like to keep those to 1 to 4 family, but you can essentially wrap them all into one note for convenience.
That's probably a good tip for people to know, because I got texted the other day, like, how can the small single family home, I think it was a Wheaton, have a $2.7 million loan against it? Like, how did it ever appraise off? Like, no, he's cross-collateralized. It's probably that one of 10 properties that are all tied to that one loan.
That's right.
Another note on this too, let's say you cross-collateralize like 4 properties and you sell one off. You don't get all those proceeds. Like it goes, a certain percent goes
That's
towards
a great point.
the loan.
With our product, it would be 120% release. So what that means is, we would, as we set the loan up, we would allocate the certain principal amount to each property. So if you have 10 properties, it's $1 million for just argument's sake here. It's $100,000 per property. In order to release one of those, we're going to want 120% of that amount. It's not a penalty necessarily, so it does go to principal pay down. But to
You
your
just have a
point,
lower loan to value. You don't have the money in your checking account.
Yeah,
Right. Like that's, you're less liquid, but your loan is being paid down.
that's
And
right.
you owe less.
I remember being like,
want
well, why
way
is
less.
this? And like, well, we don't want you to sell off the dog.
Yeah,
Right.
Yeah,
Like,
that's right.
if
Well,
you're the
it's-
lender, you don't want to
it's-
sell off the dog. And
Exactly right. It's
That's
designed to protect the interest position.
yeah, no,
we
makes
actually
sense.
have a borrower. We have in the property management. We have somebody. He has a portfolio of like 25 units. He got a big blanket loan, and he's starting to sell them off. I remember he was so excited how great of appraisals he got, and now that he's selling it off, they want to take so much. He's actually bringing money to the table on the first couple in order to hit whatever the numbers are to make sure that they're safe.
That's what happens when you sell the dog.
Yeah.
Yeah. So he'll ultimately make all his money, but he's putting him in a bad spot because he's having
Right.
cash flow issues now where he's
It's
like,
something to understand
right.
up front for sure, because there's pros and cons to doing the blanket versus the single property.
oh man, he was raving to me like, oh, what a great referral, what great appraisals. And now he's literally come out of pocket. He won't lose anything in the end. But
It's a
he's
liquidity crunch.
Yeah, it's
Like,
a liquidity. And
yeah.
I think liquidity, we see, you guys probably see it as much as we do. That's where people run into these issues where it's like, I have all this on paper, but I need $200,000 to get through the next 30 days.
I often find myself, especially some of the bigger ones, right? I'll always ask them, I go, when's enough, man? It's like, because if you total them up, right? It's like, if you sold all this off, you're probably get like $7-8 million, right? When I just go sip on a margarita somewhere, man. Why do you want to go through all this stress? Because all of a sudden it'll be like, dude, your account said you got a $1,200 here. Where he's like, yeah, it's all in 123 Main Street, 456 Main Street. It's like, so, you get those peaks and balances, right? Of, easy come, easy go and that stuff. But, I think, going back to, your point about newer investors, once you get the fever, it's kind of tough to stop, right? Even as the lender, right? It's fun to watch people grow. It's fun to talk about deals. I enjoy it. I love to see the progression,
Mhm.
That's what makes me tick. So
It's a game though.
it really is.
That's all it is. Like, when is enough? Like,
And some people
how many
are
$1
really
million
good.
flips can you do? Like,
Yeah.
I
like,
think there's
it's-
something entirely different driving the top investors, right? It's not really the bottom line anymore. It's the process. It's what they do. It's what they love.
I think it's the art of the deal, right?
Yeah.
It's finding that dog, right? And
Yeah.
fixing it up.
Well, I think there's a level of, we've always grown up hearing about quote unquote midlife crises. And I think for me, it ended up being just like survival. Like once I realized like, shit, I can survive without having to like really stress today. What's the point of life? Like I had to like reset myself of like, all right, maybe I gotta get back more. Maybe I gotta find other ways to add value to other people's life. But that midlife crisis ends up being like, I don't need to just survive anymore. And when people stop playing the game, they lose.
You know what?
They feel like they're losing.
I recently had an investor. You know, he was pushing me. Come on, we gotta close. We gotta close. I go, why, man? What's the problem? You know, I already did this one in 2019. It's in Philadelphia, right? I'm like, what's the big deal, man? I was like, chill out, you know? He was like, oh no, I got a big trade coming up. So anyway, long story short, the guy got, you know, he was going to buy some kind of Bitcoin from, I don't know, and trade something. Anyway, it was a scam. You know, so last night I talked to him. He sounded a little blue, you know, and I was like, because he had another deal coming up. And I go, man, just tell me how much it was. And he lost 60-some thousand. He was like, but that's all right. I'm going to get back on this flip. So, you know, it's those kind of things, right? That it's like, I think that's what it does for people. It just, you know, it gives you a means to make mistakes in life and still come out ahead. You know what I mean? Because the beauty of real estate is if you buy right, it typically is going to appreciate, right? And the longer that you stick around, good things will happen. You know?
Oh yeah, time's your biggest asset.
That's
That
our
is
slogan on
That's
here.
right.
just buy a brick building, don't burn it down, and in 10
That's
years
right.
later, you're fine.
And if you burn it down, just make sure you got the right insurance coverage.
like
You might actually do better.
Even there, you're fine.
Yeah,
Just like,
I'll take the check, man.
yeah, just
It's a partial burn that you actually lose money on.
I have an address here in Chicago if you know a good fire.
All right, so let's go back. We talked about the new beginning started. Can you? I don't think anyone really likes to talk about this, but when you see someone fail, what is it lack of liquidity? Is it messing up the rehab? Like, I know it's kind of all the above, but what are some of those like, hey, if I were starting, these are the things I would really focus on to just help protect that person before they jump in here?
Well, if you don't mind, I'll take this
Go
one
ahead.
because I think this is what I do every day, right? I don't care if you're a new or an old investor. If you don't buy right, you're going to lose. Unless you're like buying in maybe Hinsdale or something, you know, like some really nice area. Sometimes you can, you know, appreciation just takes over, right? But I feel like if you don't buy right, you know, that's where the dominoes start to fall, especially if you don't have a huge other portfolio to fall back on, right? So doing that and really maybe being unrealistic with your expectations up front, you know, I can get this done for 40 grand when you know really deep down your gut you can't, right? And we have measures in place. You know, we even though we don't tell them what to do, but sometimes we'll, you know, the draws team will be like, hey man, this seems a little light for what they're trying to do, because we all know what it kind of costs. And then the most common thing is like, well, I can do it myself. I'll you know, I'll do, you know, and
Yeah, I agree with everything Larry's saying. I think probably the number one reason would be contractor issues, right?
Yeah.
Like when we see a project fail, there's almost always a long backstory with what happened before we got to where we're at today.
yeah.
And it always includes a contractor that didn't deliver. And it goes back to your point of what advice would you give a flipper? Build that network, right? Understand your connections, find that person that can guide you through it, because it's those type of relationships that will help you get that knowledge. You know, you will get it eventually, but you can hopefully avoid some of those missteps if you take those steps beforehand.
Yeah.
We were talking about the other day on a different podcast. I think the best real estate partner you could have is a general contractor.
Yeah.
It really is.
Build that
If
prevention
you're
right
looking
in.
at somebody like me, like I got this part of the business figured out. I need boots on the ground, right? And I think that's what you need to look for as you look at how you're going to set up your business. Is what do you need to surround yourself with that you don't excel at?
Yep.
And nobody excels at it all. And I think that's a really big part of building that network and understanding.
And
stay in your
and you
lane.
can't just say, I got a GC, right? Because those GCs make mistakes too and maybe don't allocate their time to your project. So you need to know, I need a good plumber. I need a good electrician. I need a good drywall guy, a framer, because you know what? That handyman can't do it all, right? Nor
Right.
do they have the skill to do that or the skill set.
If you don't
Typically,
have those contacts, you
Yeah.
can't manage your contract.
there's a reason why you get specialized in a certain field, right? An HVAC guy does HVAC, right? Plumbers do plumbing, you know. Roofers do roofers, you know. So that's the most important thing is, you know, you got to have that network, man.
Yeah, absolutely. All right, so let's talk a little bit about rates, right? So everyone's, oh my God, they're so high, blah, blah, blah. You know, what has your business been like from call it 2 years ago to now, right? Rates are up. Has that volume's probably down across the board with everyone? We talked to real estate agents, we talked to title companies. Just what have you guys seen? Who again, follow up to that, who has thrived through this? Like which one of your clients
Well,
or persona of client, I should say?
I mean, to be honest with you, the good ones still find the deals. So I guess I tell everybody, a rate is just a number on a piece of paper, right? Yes, it's important. I get it because your cash flow is better and, your number is always what you spend every month is going to be lower. However, the cost of money goes up, but usually you can kind of pass that through a little bit, right? That just means your renter is going to have to pay a little bit more. Your contractors, maybe you can negotiate a little bit better there. Maybe you can trim the fat somewhere out of those. But I don't think it should ever discourage anybody, even if we're in a little bit higher interest rate, environment right now. My volumes, I joke with him every time the funding report comes out. I go, this is busier than it was when, we were giving out 3.5%, 4%, even though it's 7.5%, there's still value there, right? And eventually, again, if you buy right and you do all the right things, and if rates come down, it's still going to be a home run anyway.
Yeah, I totally agree. I would just say that, if the deal pencils, if it makes money, it makes sense. And I think if you look at the United States, half the homes out there are 40 years or older now. And so there's really going to be steady need for what we do, even if rates go up, right?
Yeah.
But if they pencil, they make money, they make sense.
Well, your type of capital is new in the last 10, 15 years. Like it was either you got something conventional or you went to Guido on the corner and got some truly hard money. Like people today don't know what real hard money is.
That's hard money.
But so you guys created this whole another tier in between, and that's even changed so much in the last. There's been a lot of consolidation. And do you think any of your guys' business now is because you guys are some of the the numbers like down in half? Correct me if I'm wrong, as far as how many.
I guess
how many of you are there out there?
Well, that's a good question, because if you look back 10 years ago when this started, it was a very fragmented industry, right? You couldn't measure it, right? Now in the world of HMDA, and there are certain things now you can measure slightly. I kind of look at it, it's become more institutionalized, for sure. I think competition is probably more fierce today than I remember 10 years ago. I was in it, almost 10 years ago. So I think there's been some consolidation, and you've seen, maybe it's more structured, if you will, but I think it's actually more competitive. And I think when lenders compete, investors are going to win. And so I think there's been consolidation, but I just kind of look at that as kind of the framework of developing the market. And so I don't know if it's changed a lot, because I think it is, at least in my eyes, it's more competitive. It just seems like
I would agree
more
with
people.
that. There's we go to shows across the country, right? And you see the same competitors, and you see their CEOs they all collaborate, right? So it's not like hey, don't talk to that guy. They seem to be all buddies, right? And they kind of bounce ideas off each other.
Not a week goes by I don't hear about a lender. I'm like, who are these guys?
Yeah.
And then you find out they're bigger than you thought.
Yeah, and you're like,
they're
holy
all over the
smokes,
place.
this is pretty cool what they're doing, right? So everybody's got their little twist, and I think everybody's very similar in what they do, and that's where it comes back to, like, who do you like to work with? Who do you prefer? Who do you trust with your finances, right?
So with competition being stiffer, and we were talking about having your network for an real estate investor, how do you guys network? How do you guys find new clients? Or how do you guys show up in the right places to create that access to who your ultimate borrowers are?
Well,
It's not on LinkedIn. We know that.
Yeah. Well, you'd be surprised who you meet in the can, But
I asked Larry how many times I asked him to open his LinkedIn account.
yeah. Oh God, he's been talking to me probably for the last 5 years. They even went so far as like, hey, if you guys don't do this, you guys are going to get locked out of whatever programs, right? They never did that, so I called their bluff. But anyway, but I really need to do that. But anyway, how do we do it? I go to a lot of local investor meetups. That's how I met like Gary Davidson and like other great attorneys like Gina Diaz, Diaz Case Law. I go to her events. They're very nice. These are all extremely warm people that they're looking to help each other. You know what I mean? I think in the most part, everybody kind of likes to know who they're working with and who they trust. And, I'm sure you guys, whatever guy you use, you've been using them forever, right? Why? Because you know what, he comes through for you, and you like what you like, right?
Yeah, we definitely do a lot of social selling, if you will, but nothing replaces the relationships and the face-to-face connections you make locally.
Yeah.
Yeah.
And you traveling around the country and doing this? Or you
Yeah.
just like you're
Yeah, no, I recently got back from Miami. Went, what was that?
you look like
Anfield.
that.
Yeah, no, I like it. I like it over there, man. Those are great shows. All of a sudden, so we were hosting a party. I didn't know where it was. I don't ask a lot of questions, man. Just kind of like, I was like, what are we doing today? I was like, oh, and then all of a sudden come down here. I was like, oh, okay, this is kind of a real deal. So anyway, it was a Saturday morning. We were hosting this event at one of the day clubs there. I had a t-shirt and I don't know, just your Saturday kind of t-shirt and a pair of shorts on. I come in and everybody's like decked out, like they're going out, right? And it's like 11 o'clock. I'm like, all right, I got to go back to the hotel because I'm not going to be the only guy dressed like this, you know? But no, I went there. I went to a show in Las Vegas. Those are always really good because there you get to kind of capture some of the West Coast. We went to a show in San Francisco, Austin. I mean, so whenever there's a good city, that's usually when I throw my name down. Now, if we're going to Toledo or something, excuse me if you're from Toledo, but I'm probably not going to go to that event, you know, but
Yeah. Do you, and you don't have to answer this, we can cut it, but would you mind sharing how does this, like the actual business model work? Meaning, where are you guys getting your funds from? Like, who are you, not personally, but as a company?
Sure.
Like, where is this money coming from? Is this private investors getting
Sure.
X%, and then you're turning around and doing, you know, this business model to make sure that you're exceeding said returns? Like, who is behind the scenes with the funds?
Yeah, I mean, and I think that's kind of the ultimate, challenge for every company to create their own advantage through that resource. And we've really kind of, approached it in multiple kind of facets. You know, you have securitizations, you have whole loan sales, there's insurance money out there now. You know, so really that's kind of the focus that Rock360 has had throughout all this. And at no point, even through COVID, did they stop lending. We really have all of that. We have our own REIT. So we are launching our own securitizations now. We sell loans at a whole loan sales. You balance sheet some of it. So I think it's the bigger companies now are kind of forced into having a multiple phased approach in how they raise capital.
Got it. Makes sense.
yeah. It's kind of like a game of poker, man. The guy with the most chips is probably going to win, you know, so you don't want to fund yourself out of business, of course, right? By just, funding anything that
It's
you
the
can
same
get
with
your
doing
hands on.
deals, right? Like
That's
the guy
right.
with the biggest war chest has that advantage.
Yeah, that's
and
right.
he could also go broke doing too many good deals.
That's
Like,
right.
there's a line there.
Yeah,
Yep.
so it's a fine line.
You
Yeah.
guys touched on this a little already, but fortunately and hopefully never I'll have to experience. But what happens when somebody stops making payments, or someone's contractor screws them and takes $200,000? Like, how does that ultimately? You guys don't want to ever be the landlords
Right.
that own the property. How do you work with? Maybe it's just an industry question in general. Like, how does that work to get people back on track, or when do you actually take the property back? Like,
Well, and I think that's an important facet of what we do, right? And it's not the easy part. Really we focus on, trying to keep in close contact with an investor when things go sideways. There are a lot of things we can do to help coach and support them through that. We have a snap draw process. We can get them same day cash to help them with cash management. So we really try to explore all options and opportunities for success. In the end, a lender does have to protect their interests, and not every deal is a success story. By far and large, though, if you work with the lender that has that approach, you'll get through more of those. Now, you may not make what you wanted to make, but you should come out the other end of it. And usually you may not make the money you wanted to make, but the experience you've gained going through one of those is invaluable. But we just really take it at the approach of trying to be in contact, communication, and supporting them where we can. If you buy right, you put together. One of the things I preach, because as you get involved with the projects that don't work out, one of the things that is probably the most common theme throughout them is a scope of work. More times than not, they just completely undershot the scope of work and just didn't have the detail they needed. And so the project was kind of set to fail from the beginning. So any advice I could give to a new investor out there, I would say take the time to get detailed on your scope of work. Every lender's going to ask you for that scope of work right up front, right? You don't have the time sometimes, but you want to get that to your lender as complete as possible, because that really does not only drive the back end draw process, but it also really creates the stage on your values. And that's one common thing that I see all the time in a broken project is just, you can take one look at their budget and go, geez, what were they doing? You really don't even know by looking at it. And it starts to unravel from there.
Have you ever had anyone just skip town?
Oh, sure. Sure. I mean, when markets change, there are some changes that would, incent people just to kind of throw the keys back and walk away. And those type of things are going to happen. When markets change, that's probably the number one thing that we'll look at is home values. If home values stay stable, all the pieces that we throw into, risk mitigation are going to hold true. Once that starts to unravel, you really start to need to pull in a few more levers probably, but that does happen, unfortunately.
I've heard investors say you can only be so bankrupt.
That's right.
Screw it.
Terrible
Well,
mindset.
these are business
bad.
purpose loans.
So bad.
Business purpose loans, and I think at some point they do make a business decision. And
But that's why you don't see extremely high leverages. That's why you don't see cash out to 95 or, 100% cash out because of those exact things. Things happen, right? But we, if you're at the end of your term, we do have a pretty simple process for somebody to get an extension. So it's not all doom and gloom, and they work with them to try to get back on track. I've had a couple people where, they were like, dog ate my homework kind of thing. But you know what? They got caught up, and you just want them to finish and then ultimately get off your books.
yeah,
Right?
we take the approach is we're partnering you. When we close that loan, we're partnering you for that project. And we certainly want to help see it through to the end as a success. And with that attitude, I think it just helps breed that, teamwork and communication.
Because we are not a property management company, right? So we don't want the properties. We want to see them succeed, whether that's just selling the asset to pay us back or.
No, let's be clear. When those things happen, we lose along with the investor. There's no winners there when those happen.
Yeah.
We're happy to be a property management company, just so we're on the same page. Well, so it's such a fine line of risk. Like you want to be competitive against all the other people that want to give these people money, but it's like, I don't want to give too much because then you put yourself, you kind of put your neck out there.
Yeah, that's right.
Where do you guys think that you guys are, call it more advantageous around leveraging your own risk to provide a better product, better service?
If you're asking how aggressive are we, yeah, I think that's what I was hearing.
No, you paraphrase it pretty good there.
All right. I think we are actually fairly aggressive. I know we do what we call lopsided deals or extensive rehabs, right? So we'll take on that $50,000 purchase price with a $120,000 rehab budget. I know a lot of places won't, because it is lopsided. Yeah, we take on no experience. We have a credit committee that kind of bounces off ideas and how they feel about, everybody says like, oh, credit committee this. I was like, it's actually better because you know what? If you're picking up a file, you might not see what he sees, right? So it's kind of good to get a collaboration of ideas as far as, what risk are we willing to take on? I think, to be honest with you, we do mid-construction. We never used to do that. If somebody had a ground up construction where you had just an empty dirt, right? And they just got it framed out with a roof. That's now a fix and flip loan, even though it's a shell, right? We don't, some of our things that we don't require title date downs on our draw process. So we don't require all 33 or all 32. So these are things that, and to be honest with you, we don't require you to pull permits. Now we want you, probably to do whatever the city recommends because you wouldn't want anything illegal to be done with your house, right? And our asset as well. But, these are things we don't require. We don't babysit you to do. We have the loans for experienced investors and we, assume that you're going to do the right thing, right?
Yeah, I would add it's really truly a common sense approach to how we underwrite. And I would go back to, we take a lot of risks. A lot of the projects that Larry described there are projects our competitors won't take on. But I think really we're successful doing it because we really underwrite a little bit differently too. Like we're going to really look at their track record. Some lenders will just count a number and it's like 4. We don't do that, right? We don't have a cutoff on how far back we'll look. We're really trying to look at the totality of what they've done and is it a fit for what they're trying to do? And if that is a yes, they come out successful far more than they don't.
And we'll even give you credit for industry experience. So if you're a licensed GC, a realtor, you know, maybe you don't have that nice, neat little track record, right? Well, me and my buddy did it, but I don't see your name anywhere, Mr. Borrower. You know what I mean? That's technically your buddy's. You know, most lenders are going to say that's your buddy's experience. You know, if we can make sense of it, if we see his signature is maybe on a HUD or on a permit application, we'll give him credit for that stuff. So we'll still get aggressive with our leverage for, you know, that outside the box thing. So we don't really have this square little box. And I kind of like it that way. At first, it was very difficult for me to wrap my mind around it. I was like, how do you not have a,
It's not the easiest framework to sell in, but,
Right.
it's definitely the best for the
but then
for
you
the
see the
investor.
method there in madness, and it was like, that makes sense.
It's
Let's
the
do it.
best to sell in.
Yeah.
So what happens if interest rates go to 10%? What does that do to you guys?
You know, honestly, kind of back what I said earlier. I mean, I think there's, you know, as the country ages, you know, if the deals pencil, investors are going to do them. And, you know, so, you know, if you look back at pre-COVID, right, you know, rates spiked up when COVID hit, then they're kind of back down, kind of close to where they were at that time. However, market rates are far higher today than they were at that time. And so I think it compressed margins. And I think that same kind of the spreads, I think that same thing will happen. But, you know, when there's a true need, you know, we can fill that need.
Yeah, and to be honest with you, that doesn't scare me at all. I back in '08, I seen that, right? It was 4.5%, 5% or whatever, and then they spiked to 7.25% next day, right? So it's like once you've already seen the movie, you know how it ends, right? And for me personally, it doesn't scare me because guess what? If I'm at 10%, so is that guy, and the other guy's probably going to be at 12, right? So, you know, it is what it is, man.
Does your industry ever have the capital dry up or the sources dry up? Is that ever a risk
Oh yeah.
for you guys?
For sure. And it's kind of happened, right, at certain points, right? Securitization market completely stopped.
Hence we were sold.
Well, what happened then? Well, all the insurance money came in. So, you know, it certainly can happen. You know, will something else pivot and deviate? My guess is yes. You know, when markets change, there's opportunities, and whether it's for lenders or for investors, that's true. And I think that's the American way, right? People are going to jump in to take advantage of those opportunities.
Yeah.
Cool. Good stuff. Ready to wrap?
Ready to wrap?
Let's do it. Double wrap up round.
Yeah.
Two answers coming.
All right. So what has been your competitive advantage? How have you guys been able to do this while so many others wish they could?
Two quick things. I'll go with white label, our white label platform, and our snap draw process are two things that sets us apart from our competitors.
Yeah, and I would just say, striving just to become better, making modifications. They send out a lot of surveys, so they take in regard everybody's feedback, right? And we try to make it better experience for brokers, borrowers, the people that ultimately work here that are on the front lines like myself, right? Kick and scream enough, they usually fix it. So it's a necessary function.
All right. What is one piece of advice you would tell someone that is yet to buy their first property?
Don't wait.
There you go.
Because guess what? It's not going to get any cheaper. I don't want to hear, oh, I'll do it when rates come down. Guess what? That will be too late. So now is the best time. You know, what the mind can perceive, it will achieve, right? So if this is something that you've always wanted to do, surround yourself with good people, find yourself a good lender, and just do it.
Yeah, but I totally agree. Stay within your abilities. You know, start off a little bit slower, build up to the bigger scopes of work. Don't bite off more than you can chew.
And that's what's beautiful about Chicago, right? Because you have every neighborhood at different price points, right? So if you are not comfortable with spending 2 or 3 or 400,000, right? You can maybe go to some of the other neighborhoods there that your entry point's 100 to 150 or 200, and you can still achieve the same amount of cash flow, and you can still achieve the same goals just by, you know, maybe making it more comfortable for you, right? You don't want to take on more than you can handle as well. So,
all right. What do you guys do for fun?
Family. My family. If I'm not working, I'm doing something with my family. I've been a single dad with full custody of my kids for 25 years now. So, and I'm going to be a grandpa this year. So
Congrats.
I'm going to focus.
Glenn.
I'm going to focus on how to be a grandpa, the best grandpa I can be.
give us a good book, podcast, or self-development activity you'd recommend to our listeners.
You know what? I'm an avid reader, so probably the best book that I can recommend to anybody would be The Success System That Never Fails. And it's by 𝗬𝗏𝗵𝗁. It just inspires you to action. So,
And he was like Carnegie's mentor, right?
yes, he was.
Yeah, okay.
Most people probably don't know who the guy is. I mean, I believe he founded Aon Insurance, right?
Yep.
It's a brilliant book because it's so simple. It's an easy read. And if you apply those principles that were set in 1900 or whenever he was an author of that thing, you know, it still applies, maybe even more today, right? So,
Well, obviously, aside from straight up Chicago, I would throw in there Row the Boat. It's a book that I'm just starting to read. It's, I think, John Gordon and 𝗵𝗃𝗃𝗃, the coach of Minnesota,
Yeah.
football coach. It's really about leading with enthusiasm and creating culture. And so far, so good.
what's it called again?
Row the Boat.
Row the Boat. I was going to say Dr. Seuss. No?
That's my second favorite.
It will be soon.
There I will
with
be.
your grandkids. All right. So besides yourself, name one person in your local network you'd highly recommend to other Chicago investors.
I'm going to say Larry Baszynski.
Oh,
This guy right
boy.
next to me here. There is nothing more valuable than building a relationship with a lender that's going to work with you and having a resource that can help guide you through a process. And there's lots of pieces to that network, but the lender is no small part of it.
Yeah, I do appreciate that. I don't know if I can live up to that expectation, but you know, just to avoid you know, hurting anybody's feelings, there's too many to name, man. Like I said, I would go to your local RIA meeting and you'll find somebody that will inspire you.
I can't let you guys off the hook. You referring him and you referring no one. Like, our listeners would be disappointed if we let you do that. Come on.
Well, we're going to drop a few names today.
Drop
Yes.
a couple names.
there's a-
Say this guy's awesome in this guy's
Yeah.
awesome in this, and I apologize to everyone else I forgot. Like that's what they usually do.
Yeah, no.
All right. Man, we're gonna have to link to it. We're gonna have to get it off air. Link to it in the show
You know
notes.
what? I'm gonna create my LinkedIn, and whatever people you see on there, those are the people I'm gonna recommend, man.
Make a
because-
commitment on the air. You got to do it then.
Yeah, you know what I am. That's my
Yeah.
commitment to everybody. I'm gonna do that.
I think for the listener's sake, to get you off the hook for not dropping any names, I'm going to do a screenshot of your LinkedIn 30 days from now on the Straight Up
Oh,
Chicago
Jesus.
Facebook club, which now has 2,600 members.
Oh, come on, man.
Chicago.
Don't do that.
So you
Don't
got
do
30
that.
days,
Please
dude.
do that. Please do that.
Oh, please don't.
All you
right.
gotta do is drop a name.
Larry
All right.
Scott, you guys have been awesome. You provided a ton of value to our listeners. How can they learn more about you? Obviously, not LinkedIn. Is there any way they can provide value to you?
Yeah, listen, first of all, thanks for having us here today. I would say, hey, everybody out there listening, come join us June 13th at Ultra Brewery and Kitchen in Oak Brook from 6 to 9 for some drinks and some food and great conversation.
And we're going to put there's a register link that we'll put right on straightupchicagoinvestor.com. So perfect.
Yeah, very cool.
All right. Very good. Are you ready for our Chicago fact?
Yep.
Who are we playing for? Who's sponsoring?
All right, today we're playing for Jada Jacobson. She bought a T-shirt off the Straight Up Chicago Investor merch store, and our sponsor today is Lavelle Law Chance. And if one of us three, so we got a good chance here, gets this question right, Jada gets a $50 gift card brought to you by Lavelle Law.
All right. So we mentioned this is the event is out in Oak Brook.
Yeah.
Oak Brook was the hometown of this made man from the Chicago outfit. And your options are Frank Calabrese Sr., Johnny Torrio, Sam Giancana, Alan Dorfman.
First one.
Boy,
I'm going option 2. I don't.
I was
That'd be
gonna
Johnny
say
Torrio.
Sam.
Yes.
Yeah, they didn't even have Oak Brook. Didn't even exist then.
Oh, there you go. Using some timeline on
Yeah,
here.
yeah,
he did.
Yeah, that's pretty sharp.
Mark, yeah. Well, Frankie Breeze is the answer. He got it. You don't even need to go here.
Wow.
Well
Good.
done.
He's the
done.
one his son ratted him out in The Family Secrets, right?
Yep.
That book.
Yeah, yep.
His son was the one who
Was
ratted
it
him
really?
out.
That was him.
Yeah.
Frank Calabrese and Frank
Okay.
Calabrese Jr. All right. Well, man, dude, thanks for showing up here today.
Thank you.
guys are awesome.
I'm looking forward to June 13th. Listeners, go to straightupchicagoinvestor.com and register for this event. It'll be a good networking event, 6 to 9 in Oak Brook on June 13th.
Plus, you get free drinks. I mean, duh.
Free drinks.
come
I
on.
think you guys got some pretty cool prizes and giveaways that you guys are giving away.
Yeah, actually, for all people that come that haven't done a loan with us, we will give you a free appraisal. Yes, free. And in most markets, that's anywhere from $700 to $900 value, depending on how many units it is. So do it. If you've never tried it, try it. And if you like it, well, then we're going to work for years to come. And if not, go back to whoever you use. No
All
problem.
right. Well, guys, thank you so much. Tom, thank you as always. Listeners, we will see you next week.
Thanks all.
Thanks.
Thank you.